thanks again for all of you for joining us today in our webinar on short-term electricity prices, how AI can help you build confidence in the current market volatility. To start, I'm Giancarlo Marzano, work here at Enside as an energy analytics analyst in our forecasting department. And I'm glad to welcome you here today. And in this webinar, we're going to show you how we leverage AI in short-term forecast solutions in order to build confidence. Today, we're going to show you how the combination of machine learning knowledge and domain expertise in power systems has been used within the Enside team in order to build and create value on energy markets with the specific application on the imbalance pricing solutions in Belgium. I see that we have still more people joining us. It's great to see so. We have more than 100 attendees expected for today's, all joining from different companies. And because we have 1 hour for this webinar, I'm gonna just briefly introduce a bit of technicalities regarding the setup that we're using today, as well as discussing a bit what is Enside doing and what is our mission for the ones that do not know us already. So let's jump into it. Initially, as probably many of you after these couple of years of pandemics have been experiencing in the past, we're using a technical platform for this webinar called Demio. This platform is really customizable. You have different options, just adjusting screen sizes, and also a chat and poll section on the top right-hand side. I would like to emphasize the importance of the chat. We left it in public mode in order for all of you to feel free to really share what are your questions, doubts, and everything that you would like to exchange and to discuss in the webinar. We have some dedicated time at the end for the question and answers, so really don't hesitate to bring up any questions you might have. And for the ones that, due to constraints of time, we will not be able to address, we're going to take them offline at a further stage. So really ask any question that you would like. Same way for the polls, we have an interactive setup in this webinar. Hence, we will present a couple of polls. Use the top right corner in order to vote for the options that you would like. And now, a couple of words of Enside and what do we do. We have been around now for a bit more than 20 years with the mission of enabling the energy transition with innovative and advanced analytic solutions. We're present both in Europe with offices in Belgium as well as in the United States, with a strong connection with academia with a more than 30% PhDs and a really international background with more than 30 different nationalities represented by our team. And in short, we provide expertise and deploy software solutions for different partners in the energy sector, ranging from market participants to power exchanges and distribution and transmission system operator. One of our most famous solutions, the flagship, is the day-ahead market clearing optimization tool called Eufemia, which we use for European power exchanges. But without further hesitating, I'm gonna dive a bit in our different speakers of today. So today I have the pleasure of introducing you Michael Malcorps, which has been part of the Enside Energy team for more than 1 year. He has an extensive expertise in energy markets and the application of advanced analytic solutions with a background in business engineering. And on the other side, we have Pierre Artoisenet. He has been he's a bit more of a seasoned member of the Enside team, part of the team for more than 4 years, with an extensive expertise in artificial intelligence and machine learning. And I'm sure that we're all looking forward to hear what they have to say in terms of short-term forecasting. But before doing so, I have a bit of a teaser of a LinkedIn poll that we presented in the past days regarding the percentage of times of the imbalance prices in Belgium, how many times these were above 300 euros per megawatt hour since the beginning of 2022. We have 4 different options, and we opened the poll on LinkedIn in the past days, where we have either 1%, 15%, 25%, or 40%. So for the most curious of you who have been participating to the poll already, the solution and the answer is 25%. It's a surprisingly high number, actually. In the past year, it was only 1%, and this really shows how the energy market has been increased in volatility in the past year. And I really hope that, like, after this webinar, you're going to have a bit more insight of how these different artificial intelligence and machine learning solutions can help cope with this increasing volatility that we face in the market today. But now it's time to leave the word to the speakers of today, and I'll pass the floor to Michael, in order to discuss how can AI help you build confidence in the current market volatility. Thanks a lot.
Thank you, Giancarlo. I'll actually start with a simple question to you guys. Why are you here today? Why have you subscribed to this webinar? Well, these are the weekly average day-ahead electricity prices that we have seen roughly in all Central and Western European countries since 2015. And we believe you are looking at this and asking yourselves where this is going to end. These extreme prices, but also this increasing volatility in short-term electricity markets pushes you currently to equip yourselves with the overall objective to regain confidence in the positions you are taking every day on the markets. So you are looking for solutions. And how do you do so? Being traders, electricity producers, flexible asset owners, you are relying on your in-house experts, including sometimes yourselves. And these experts, they need to build knowledge on electricity prices. And at the same time, they need to interact with different sorts of models. On one hand, more traditional ones, like simple linear regressions on recent price signals or clustering methods. And on the other hand, more advanced ones, relying on machine learning algorithms like decision trees or neural networks. So all in all, you need experts. And these experts, they need models to forecast the right prices and take their positions. Going to the roots of the why do you want to forecast prices? Because we believe you want to manage your risks the best way possible. Here's the example of the Belgian imbalance price of last Friday, 22nd of April. It's the middle of the day. And first poll for you, do you think it went upwards, downwards, or remained stable? We are giving you a couple of seconds to share your best guess. Of course, not an easy guess. And nice to see. Of course, it's very mixed, right? Just giving you a few more seconds. So it's quite shared between the different solutions, but I can say that actually the system imbalance went a bit more negative at that time, meaning that the imbalance went slightly upwards to almost reach the 300 euro per megawatt hour mark, yet without crossing it. Probably due to some short in the renewables that were forecasted in the intraday. So yeah, that went slightly upwards. So for the 17 who answered properly, bravo. Anyways, every day and at every minute, you would like to anticipate the trend of this imbalance price and know if you want to take part in this market, assessing the impact of fundamentals. Whereas in the past, you were relying on a single forecast of the price it will be for the next time windows, we are seeing you more and more asking yourself, what is the probability that this is going to go in each of these three directions? So there is a clear switch in what you are looking for, from where is it going to land to how confident am I that it is going to land at that stage. To provide these predictions, technology-wise, artificial intelligence algorithms have had quite a hard time in the latest month, as we humans all had quite a hard time, by the way. Having a look at the evolution of imbalance prices together with their standard deviation since the beginning of 2021, we realized that both the level of the prices and their volatility has increased substantially, which reveals a clear structural change in the markets. And from our experience, we can say that classical machine learning algorithms, without injecting any knowledge, have not been working so well in these conditions on energy markets, as the training set does not give the information required to perform properly. Hence the need for a mixed approach, which we have worked on. As a result, since a few months, we've been focusing on injecting even more knowledge in the AI models, combining the best of both worlds to generate the highest value. This eventually allows the model to provide good results, which are at the same time interpretable by the experts, bringing transparency on algorithms which are not always easy to grasp. So I think I've talked enough to set the scene. Let's get now to the core contents and what are you going to learn today, actually. So we have chosen to showcase a specific example of application of this approach on short-term electricity prices with the imbalance price in Belgium. Hence, we'll start by sharing some knowledge on this imbalance price and the way it is set at every minute. We'll then explain specifically how AI-powered technologies can be used as a real ally in the decision-making regarding the positions to take on the markets, providing confidence levels. We'll also share with you the 5 ingredients required for it to work. And finally, as this is the name of the game, we'll make sure to give you an indication of what it means regarding impact on your P&L, taking a specific example. Before giving the floor to Pierre, next little poll introduced by Giancarlo.
Well, our next question is regarding the current status of how you forecast in your company. What are you relying on today in order to forecast imbalance prices or any other sort of short-term electricity price or volume which is relevant to you and your organization? Here we have 4 different options: in-house models developed internally in your company, the latest available public data, so for example, TSO data shared through their platforms. Thirdly, the forecasting data provider, an external source where you import that, or other options. I start seeing answers to the poll. And please continue voting and continue telling us how you're doing it today. I see the vast majority is utilizing in-house developed models, but still there are quite some representing the other options, and would be really great to hear more about them. Feel free to share in the chat what are you using and what do you mean with other solutions. And I see that most likely most of you have voted. Thanks a lot for the participation. To mention a bit the results, we have a vast majority, almost 50% utilizing in-house models, followed then by 33% with other solutions. And we then conclude with a few answers also leveraging the available public data from TSO. Thanks a lot again for your participation. Don't hesitate to keep on asking questions. And it's time now to leave the floor to Pierre for continuing on the webinar.
Thank you, Giancarlo. So let us jump into the core of the subject right away and start by reviewing the balancing mechanism in Belgium, also introduce some terminology. So what you see on the upper side of the slide, it's a plot with a time series shown in orange, that the system imbalance, so that's the network imbalance with respect to the day rate schedule. And you know that the TSO has to compensate that volume in imbalance by activating upward or downward regulation volumes. And the sum of these volumes in a given period is what we call the net regulation volume, or NRV. So the NRV is a quantity that is important for us because it drives the calculation of the imbalance price in the following way. If the NRV is positive, then the imbalance price is set to the highest price paid by Elia for upward regulation, something that is called the MIP, for marginal incremental price. And you can see that price in the lower plot. It's shown as an orange time series. On the contrary, if the NRV is negative, then the imbalance price is set to the lowest price received by Elia for downward regulation. And that price is called the MVP, for marginal decremental price. You can also see the price for a specific time window in the lower plot, shown as a blue time series. And as a result of these calculation rules for the imbalance price, you can see that the imbalance price that is also shown in the plot as a green line, it's oscillating between the MIP and the MVP, leading to quite a complex time series profile. And of course, it's quite difficult to anticipate beforehand because the way the market participant will behave and will react on the price signals depends on their flexibility. So it's a tough task to predict the imbalance price in advance. And because it's a complex task, it's worthwhile to break down the complexity. So there are several questions that you may ask yourself. Maybe the first question is, can you anticipate whether the activated regulation volumes will be mostly upward or mostly downward? So that is to say, can you anticipate whether the NRV will be positive or negative? Because example given, if you can anticipate it will be mostly upward, so positive NRV, you already know that the imbalance price will be higher than the price of the cheapest activation upward. So it reduces the region of possible values for the imbalance. But then, of course, you may want to refine your prediction and go to the next question, namely the prediction of the marginal price upward. So there, the relevant question is, can you anticipate whether secondary plus tertiary reserves will be activated, yes or not? So what are the odds to see high imbalance prices? So all these questions related to the prediction of the MIP, and analogously, if you are confident that the NRV will be negative, then you may ask yourself, okay, to which extent I can actually predict the marginal price downward. So in this webinar, we will see how we can answer these questions to some extent using AI, and more specifically using supervised learning. So it's good to take a bit of time and see what does it mean to use supervised learning in this specific case for the prediction of the imbalance price. What you see on that slide, it's a timeline with different 15 minutes block for which we have one imbalance price. So these blocks, they are called the imbalance settlement periods, abbreviated as ISP, and this is an abbreviation that I will use thoroughly during the webinar. So one of them is highlighted in green. So let us assume that we want to forecast the imbalance price for that specific block in green. So in this webinar, we will assume that we want to do that prediction 11 minutes before the start of the target ISP. So at the time that is depicted by this orange indicator here. So that the price of ISP -2, so the period that is shifted by 30 minutes in the past, it's known, and you can use that information in the forecast. Of course, you can use we can use all other type of information on activations, either volume information or price of information, and other types of information such as forecast of wind generation, solar generation, consumption. So all the information that is available by the time of the forecast. So the way supervised learning works is as follows. So we build a set of features that you see here in blue, and the goal is to build a function, f of x, that will combine the features in such a way to provide an estimate of the imbalance price. So that's the response that we want to predict in our case. And of course, you know that there are different algorithms to construct that f, and we will say a few words about the approach that we follow for this problem. But all the methods in that category of supervised learning, they all work by using historical occurrences, including both feature and response information, and use that set of information to fit this function f of x to the best estimate of the imbalance price. So that's called the training. Typically, you keep a validation set aside to fine-tune the hyperparameters of your algorithm. And then, of course, the final performance has to be assessed on the test set that has not been seen by the algorithm. So we will deep dive into the construction of F in that specific case. But before I do that, I would like to give the floor back to Michael, I believe, who will talk about the main ingredients in AI models.
Indeed, before diving into the actual design of the model, let's take a quick step back on the main features which are important for such a forecast. Some of you who have attended our past webinars might have already seen this, but next to the injection of specific expertise into the models, we believe that there are 5 main ingredients which allow AI models to generate the highest value. 1, choosing the right technology. So which approach do we choose to use to learn from the past, be it recent or more distant, and balance the right level of complexity and relevance and significance. 2, controlling the forecast uncertainty, which is very central in this webinar. So how do we control the risk of error in the output of the algorithm and make it very visible to the user? 3, providing transparency. So how do we better understand the key drivers in the output of the algorithm, hence removing this well-known black box effects of AI? 4, fitting the model objective to the business purpose. So how do we want to tune the learning towards the pursued business objective? And 5, ensuring high reactivity, so asking ourselves when it is needed to update the algorithm. The upcoming Mari Picasso Go Live is a good example of that for the forecasting of the imbalance prices, by the way. Today, we have actually chosen to focus on the 3 first ingredients, while the 2 others were quite well covered in our last webinar on intraday market arbitrage. So feel free to give it a check. The replay is available on our website. So Pierre, I let you know, illustrate the ingredients in the context of this imbalance price forecast in Belgium.
Thank you, Michael. So let's start right away with the technology. So we will use additive regression trees here in the context of this webinar. And if you want to have a high-level understanding of how that technology works, there are two main ingredients that you need to understand. So the first ingredient is a prescription to grow one tree, to build one tree, as a sequence of hierarchical splits. So you start from the full training set that was introduced earlier, and then you start splitting with the information that you have in your feature set, so using the features x1, x2, into sub-boxes. And to do that, you need a splitting criteria. So the splitting criteria, it can change from one problem to the others. Here, for the prediction of the imbalance price, it's a criteria that will tend to try to minimize the variability of prices inside the boxes and increase the variability between the boxes. So roughly speaking, it will send high prices in some boxes and the low prices in other boxes. So if you build one tree, you already have an approximate function f of x, so an approximate estimate of the response variable, but it's a weak regressor. It's called a weak regressor because the performance is quite poor, and this is why you need also the second ingredient, namely to build a sequence of trees or forest. And then there are different ways to do that. So you can either build the trees in such a way that each tree is built such that it corrects the mistakes from the previous tree. That's called boosting. And then there are different implementations, like for example, gradient descent. Or you can use more random forest, in which case you would build the trees separately. And you would build each tree based on a different subsample of your training set. Why do we use trees in the context of this webinar? So because it's handy to assess the statistical significance and also to extract the confidence levels, and that's the core of the webinar, the main topic. We'll jump into it, of course, while still giving some access to the transparency of the output of the model. So understand, okay, what is behind the output of the model? Can I understand the different drivers and how they pull the output of the model in one way or another? So let us focus first on the extraction of the confidence levels, because that's the main topic, and it's relating to the controlling the forecast uncertainty. This is in general a tough problem, and surely enough, in this case, it's a tough problem. Why? Because we are dealing with non-normal distribution. So if you look at the plot on that slide, it shows you the imbalance prices for a specific day. So that's the day of January 15. You have the price on the x-axis. On the y-axis, you see the number of periods. And what you see is that this distribution is composed of peaks that are associated with the activation of the different types of balancing capacities. So if you look at the first peak, this is associated with downward regulation. The other peaks involving higher prices, they correspond to upward activations, but you have different types of reserve, and some of them are more expensive. So if, for example, you activate R3, it's a very expensive reserve, then typically you would get a price around 600 euros. So the point here is that if you select one algorithm to predict this probability distribution, you need to select one that is able to cope with this kind of distribution. So cope with the fact that you don't have a full spectrum of prices and you don't have a normal distribution. So you have a distribution that does not match any simple parametric shape. So how do we do it? So we start with the trees, as anticipated earlier. So the first ingredient is that we extract a metric from the trees. So that metric, it allows us to determine whether the occurrences, so the periods, ISPs, are close to each other or not. This metric is very different from an Euclidean metric, because if you consider Euclidean metrics on the feature space, it would typically give the same importance to all the features. Here it's different because the trees have the ability to give more importance to the features with a high ability to discriminate the imbalance price in this case. So if a feature is not used at all in the tree because it's not useful to discriminate imbalance prices, it will not be used in the metric neither. So once we have the metrics, we jump to step number 2. So we use that metric to identify a sample of ISP, so of periods, in the training set that is close to the one for which we want to predict the imbalance price, and in spirit it's quite close to nearest neighbors. So you end up with a sample of occurrences in the training set for which you can draw the distribution of imbalance prices, and you can normalize it in such a way that you have a predicted probability distribution. And just for the sake of example, so on the top right corner, you have the example of such distribution. So it's the predicted probability distribution for the imbalance price of one single ISP. And then once you have this distribution, you can jump to the third stage, meaning so you can extract any probabilities from that distribution. We'll see some examples later on, and also confidence intervals. So the main point here is that because we have this procedure that is based on the trees, we don't make any assumption on the distribution of the residuals. And so in particular, we don't make any assumption on the normality of the data. And you can see that actually the predicted probability distribution is something that does not behave as a normal distribution. So we use that methodology to tackle the different components that we have introduced earlier. So the first one is can we anticipate whether the NRV will be positive or negative? So our model will predict the probability that the NRV is positive, probability between 0 and 1. This is what you can see in the first plot as a blue time series for a specific time window. And just for a matter of comparison, we have also plotted the NRV below, so that's the orange line in the units that you can read on the other axis. So it's the y-axis that is on the other side, on the left-hand side. Next, we can also use that method to predict confidence levels for the MIP, so the marginal incremental price. This is what you see on the second plot, and there we extracted the confidence band, the P10, P90 confidence bands. So for each period, we have the full distribution. We extract P10, P90, and then we plot it as a time series. That was done here for the MIP, but of course we can do the same exercise for the MDP. And then collecting the different components, eventually, so for each period for which we want to predict the imbalance price, we can reconstruct the probability distribution. This is what you see. You see one specific example in step 3, the last distribution on the right-hand side, where so what you see is a probability distribution for the imbalance price of that period, so starting at 8 p.m. on a specific day. And so you clearly see, for example, the contribution associated with downward regulation and the contribution associated with upward regulation. And then once again, so you observe the capability of the method to anticipate a distribution that is actually not following a normal distribution. So this is what I wanted to say about the extraction of confidence levels and probability distribution. Before we keep on deep diving into technical aspects, I would like to give the floor back to Giancarlo for a poll.
Great, and thanks a lot, Pierre. Really interesting to understand more on these different methodologies in order to forecast uncertainty and then utilize that through these confidence intervals. Yes, as you mentioned, before diving more into the ingredients, it's time for a poll. And now we would like to ask you, what is for you the most important feature of a forecast? Is it the minimization of the MAE and RMSE, so the average error in general, or does it lie on the confidence intervals linked to each forecasted value? Is it the transparency on the drivers of the forecast, or finally the reactivity to market changes? So don't hesitate to vote using the poll function on the right-hand side. I start seeing the first answers coming in. Don't hesitate to highlight more, or also if you're interested, you can also mention in the chats if you have some other items that you consider really important, such as, for example, reliability or availability of the solution. Maybe it can be even the quality of business support and in general maintenance. So really don't hesitate to give us a bit more on your insights on the topic. Well, I start seeing then like the question stabilized a bit, and for your information, then the confidence levels linked to each forecasted value seems to be the most quoted of these options. Very, very good to hear, actually, given the topic of this webinar today. Also follows then the minimization of the minimum absolute error and the root mean squared error. So in general, error metrics. And that's also like really interesting to hear. Thanks a lot again for your participation. This was the last poll for today. But again, one last reminder, don't hesitate to keep on posting your questions in the chat. Don't be worried in case of concerns of time. We'll be there in order to answer them all offline. And it's time then to give back the floor to Pierre.
Thank you, Giancarlo. So let us keep on diving into the technical aspects. So we spent already a lot of time to understand how we can extract confidence levels and control the forecast uncertainty. And I know it's time to jump into the transparency. So how do we get access to the transparency of the forecast? So we at Insight, we have developed a method that is called the multiple expansion. And it's a method to sort the different drivers and understand how they impact the response, the output of the forecast. So will it pull the output of the forecast in one direction or another direction? We actually gave a webinar on that topic and explaining in details how that method works. So here, for the sake of time management, I will not redo the explanation of that aspect. You can watch the replay of the webinar, so it's available online, no problem. So here I will simply illustrate how it works for one specific component of this problem related to the prediction of the imbalance price. So what you see on the top side of the plot, it's again the probability of a positive NRV as a function of time for 1 day. And we would like to know, so most of the time that probability is actually predicted to be close to 1. So you would like to know, okay, what drivers is actually pulling this probability close to 1. So the way it works is that you start from the input features, and in that case, we had a model with 75 features of different nature. So to make it visible, you can start classifying the 75 input features into different buckets, different classes. And here, that's one possibility. It's not the only one, but so we have one bucket on any features associated with previous balancing prices available at the time of the forecast. Another one regarding all the information on previous balancing volume. You can have another one on volume forecast. So these are all the features associated to wind forecast, solar forecast, and so on. And then once you have done that, so you can keep track what is the impact of each of these classes on the output of the forecast. And this is what you see in the plot, the bar plot at the bottom. You see, starting from a probability of 0.5, what are the drivers that will tend to increase that probability? So tend to say that the NRV will be positive, and the drivers that will pull down this probability more towards 0 as a function of time. And you can do that systematically for any time window. So for that specific time window, what you see is that actually on that specific day, a bucket such that the volume forecast did not play a big role because you don't see the contribution here in that plot, but okay, it can be different for another day. So yeah, the point here is to stress that we still have this functionality of applying this multiple decomposition and understand a bit what is behind the scene, what is behind the output of the forecast. So this being said, we have talked about the different aspects of the forecast. So I would like now to jump into one specific example to show the added value and the impact it can have on the P&L. So we'll stick to one specific example. So that's an example with a flexible asset on the production side. And here we will try to assess the possibility to anticipate high imbalance prices above 300 euro per megawatt hour. So that's the opportunity threshold. So on that plot, you see the opportunity threshold as a horizontal line, black line, together with the actual imbalance price that is shown as a blue line. And then the goal here is to anticipate whether the blue line in advance, of course, so 11 minutes before the start of the period, whether the blue line will be above or below the flat line. So if we trigger an opportunity, the way to assess if it is a good opportunity or not, it's very straightforward. So if it is a good opportunity, then the reward is set to the actual imbalance price minus the value of the threshold, which is a positive quantity. If it is a wrong opportunity, then the penalty is also set to the actual imbalance price minus the threshold, which is a negative quantity. And then you have an additional factor to account for the conversion from the 15 minutes period to a quantity that are savings per megawatt hour. So how do we trigger the opportunities? So for each ISP, so for each period, the output of the forecast, eventually, it gives us this probability distribution. And again, this is one example that you see here. So for one single ISP, you have the complete distribution, and you can see the peak structures associated with the activation of the different types of reserve capacities. And so what kind of indicators can you extract? So there are several of them. So you can, for example, extract the expected imbalance price on average. That's one of them. Then you can also look at probabilities. For example, you could look at the probability that the price is above the threshold, above 300 euro. That's the win probability, but you could also look at other probabilities. For example, the probability that the loss is higher than 200 euro. And which one to use is not that clear. So here in that specific example, if you look at the expected imbalance price for that specific distribution, it's 386 euro. So it means that if you face that situation a large number of times, on average, you would expect a positive profit on top of your opportunity threshold of 86 euro in such cases. So you may say, okay, it's quite good, I will go for it. On the other hand, if you look at the confidence that you will get a positive reward for one opportunity, that probability, it's not that high. So the probability, the win probability, it's 0.57. So the likelihood that you will win on one specific case is not so high. So you may not go for it. So if you are just interested in maximizing the net savings, then it's good to go with the expected imbalance price, and that is built upon the output of the AI model. And so if you use that one, and then so each time this expected imbalance price is higher than your threshold, you trigger the opportunities, then you can keep track all the rewards, positive or negative, you accumulate them, then you will end up with this saving curve that is shown as a blue line here on that plot. And just to give you a bit of a feeling, is it a good result or not, you can compare to a simple benchmark. And the benchmark that we use here, it's a benchmark that does not use any AI. So we replace the expected imbalance price by the latest known imbalance price and use that as a trigger. Because yeah, the latest known imbalance price, that's something that is available publicly, and you don't need any model for that. So what you can see here is that the AI model increases the savings by 200% compared to the one that you would achieve with the benchmark. So that's one option. But then, as I said earlier, you can also look at the level of confidence for one specific opportunity that the reward will be positive for that one. And in that case, you need to look at the win probability that was introduced earlier. So here on that slide, you see two plots. Both of them are quantities that are plotted per bin of the win probability. So the plot on the upper side shows you the gains and the losses per bin of this win probability. Whereas on the lower side, what you see is the number of won cases and the number of lost cases, again, per bin of this win probability. And this is for all the opportunities that have been triggered with the expected imbalance price trigger. Okay, so what you see, if you focus on the lower plot more specifically, is that the win probability reflects the frequency, reflects accurately the frequency of won cases and lost cases. Why? Because if you look at one specific example, so lower plot, and then you look at the bin in the middle, so that's the bin with the win probability centered around 0.75. The number of triggered opportunity, it's given by the blue bar, and out of these 300 triggered opportunities, the one that were won cases are shown in green, and it amounts more or less for 75 of the triggered opportunities. So that probability that was anticipated by the model reflects the actual frequency of won cases. And it works for the other bins as well. So if you go to the next bins with this win probability centered around 0.85, you see that the win bar amounts for more or less 85% of all the triggered opportunities in blue for that specific bin. So the key message here is that the anticipated win probability, again, it's an output of the model. It's an accurate indicator of the likelihood to make a profit. So this being said, I would like to give the floor back to Michael for the conclusion.
Thanks a lot, Pierre. Indeed, time to wrap up. On the three subtopics we told you we would cover during this presentation, what have we shown? So first, regarding the dynamics of imbalanced prices in Belgium, you have seen that complexity can be broken down into two parts. First, the volume, summing up to the net regulation volume, or NRV, and then the price, which is either the highest marginal incremental price or lowest marginal decremental price, depending on the sign of this NRV. So this eventually allows us to assess the odds of very high or very low imbalance prices. Then, regarding the technology and the design of a performing model, you have seen that despite the fact that the imbalance prices are not normally distributed, we have managed to build additive trees relying on random forests, allowing to extract the probability behind the different values of the forecast, while keeping a view on the different drivers of this probability, hence providing the transparency. And finally, on the value that such approach can generate, we have shown that this allows the expert to capture what he or she wants depending on how risk-averse he or she is. And by taking simple assumptions on a specific case for a flexible asset, we could already show that it could generate about 3 times more value than the benchmark relying on the latest known imbalance price. So that's about it. I think we are now ready for the Q&A. Giancarlo, the floor is yours. I think you can.
And would be great to have Pierre as well here with us. So thanks again to both of you for this great presentation, a great webinar. I think we got a lot of new insights and how basically the dynamic of our algorithm is brought up, how balance price setting in Belgium works, and how we utilize the AI in order to cope with that and actually take a solution that can handle the market volatility in a proper way. I will not say it enough and never say it enough, but please don't hesitate to keep on asking questions, keep raising points of interest that you would like to be discussed now with our experts in the Q&A. I see here a first question that is coming, which is how long is the history of market outcomes that you use for your training models? I believe that Pierre can take this first one on.
Yes. So if I understand properly the question, so it's asking about the volume of data that we use for training. So typically, so it depends a bit, but what we notice is that for the latest months, we had to actually shorten the training set quite a lot, just because of the fact that the market changes quite substantially. So whereas before we used to take a training volume of 1 or even 2 years, now it doesn't work anymore. So we have to typically take training volumes that are shorter than that, actually shorter than a year. Then, so what size exactly depends a bit on the different countries. So of course, so the steps that we have not gone into the detail is all the optimization of the hyperparameters. But this is the overall time. So we usually take training sets that are shorter. And then the impact is that, so we end up with predicted distributions that are actually relatively wide. But at least we don't have any bias in the probabilities. So the probabilities that are predicted are in line with the frequencies of win-loss cases, as I explained earlier. So yeah, the market change, it's a big challenge for us, of course, because when using supervised learning, we rely on historical data. So that's a big issue, but so we can still cope with it. It's just that, okay, we have typically predicted distributions that are a bit broader, meaning that, we have less cases that are super clear, like less cases where the win probability would be 0.999. That's a bit the impact.
Great. Thanks a lot, Pierre. And I guess that answered pretty well. There was also a question previously stated regarding alpha incentives in order to know whether that is still included in our model. And I guess that is in terms of the computation of the imbalance price. I think, again, Pierre.
Yes, indeed. So maybe for this, we can quickly jump back to a slide that was shown. Almost there. Yes, so you are completely right, actually. So sometimes there is this additional incentive, and you can see it on that plot. So if you look at the plot on the lower side of the slide, So you have the MIP that is shown as an orange line, and then so the imbalance price that is shown as a green time series. So it sits either on the MIP or the MDP, but not exactly. So for example, there is this peak where the imbalance price is a bit higher, and then there you see that there is this incentive on top of the MIP. So the green line is above the MIP time series. So you are right, this incentive is there, and it has been taken into account in the model. So here, just to simplify the discussion, I did not insist on it, but it's included.
Great. Thanks a lot again, Pierre. Another curiosity that was coming from the audience is what will be the impact of Mari Picasso on these prices? I believe that maybe Michael, you can take that over.
Yes, indeed. We have looked at that recently, of course. So we actually had the chance to be very much in touch with EU market developments, thanks to our long-standing relationships with European power exchanges, but also system operators. So we have a good view on the potential impact of Mari and Picasso on the imbalance markets. We have, of course, started to look at that to see how we could tweak our models to take this fundamental change into account once it goes live. However, we can only build scenario at this time, as the way the market will react to that change cannot be completely anticipated. What we can say is that we will need, of course, to accumulate enough new data to properly train the AI models and make sure these models capture the market changes. And we believe the strength of our approach is that we have the tools to, on one side, deal with uncertainties in the prediction of imbalance price, so make it very visible to the user that the uncertainty will actually increase when we really switch. And two, on the second side, it's like to quantify the extent to which these new market trends are captured properly by the algorithm. So we can test after the facts whether the probability, whether the predicted probabilities, they reflect the actual frequencies in the data. So if it's found, then it would show the absence of strong bias in the AI models that we are developing. So in conclusion, also, although it will become quite uncertain, we are confident that we have the tools to control that uncertainty as fast as possible. So I don't know, Pierre, if you want to add anything to that.
No, I think you summarized it well. So for sure, there will be a period of uncertainty because it's supervised learning, so it relies on historical data. But as you said, so the point is that we have the tools to try to assess as quickly as possible when we have enough data to be confident again that the model is unbiased and it's reliable to make predictions. So predict some probabilities that are accurate, so in line with the frequencies that you can calculate afterwards. And that, okay, so how much data we need? So of course, this we need to wait the go live, but we think we have the right tools to tackle the problem.
Great, thanks for the question, thanks for the great answer, and indeed, like good proof of how we combine the machine learning with the domain expertise in our models. Another question that we have from our audience. In our experience, does the model need to be trained for summertime and wintertime separately, or to take into account any seasonal effect? I believe Pierre, you're on the take for that one.
Yes, indeed. So the way we tackle it, so we have some features that we call time indicators that can be used actually to differentiate between summertime and winter time, and this is what we use right now. But yeah, I agree that another method would be to use a different model during the summer and a different model during the winter. So it's a trade-off between having models that are trained on a smaller amount of data and dealing with the fact that we have periods that do not behave exactly in the same way. So yeah, in the one that we have discussed here, so let's say the dependence in the seasonality was more incorporated into these time indicators features.
Great, thanks a lot. Well, keep on seeing questions. I see that follow-up one would be, what's the hypothesis of normality, normal distribution of residuals in the elements of the tree? Seems to be required for the usage of the Bayesian trees. It is not the case here. On how do you deal with that?
Yes, so here actually, so the trees that we have used, they are not Bayesian trees. So you can use also Bayesian additive regression trees. So it's called BART. It's another method that works very well in some cases, but once again, so in that method, there is an assumption of normality for the residuals in the termination leaves of the trees, and here it does not. That assumption does not hold. So the trees that we have used, you can see them more as frequentist trees as opposed to Bayesian trees. So the Bayesian approach, typically, you would assume parametric shape, and this is what you do in Bayesian statistics. And here, I mean, because we deal with some distributions that do not fit any simple parametric shape, that approach does not fit well, let's say, for the problem that we want to solve.
Clear. Thanks a lot for that. So one last question is regarding the approach applicable to other use cases and whether we can reuse these on solutions such as, for example, short-term electricity price forecasting.
I can take that one. Yes, indeed. I think, I mean, we've built a technology that can be applied to almost any of your short-term forecasting needs. So it can be on an arbitrage between different markets. So how confident are you to go short or long in their heads, as an example, or on a single price forecast? So we have built something which is use case agnostic, let's say. So you can provide confidence. We can provide you with confidence intervals on the price, on the volume, on the recommendation. So that's what we've built.
Great. Thanks a lot for that. I believe that maybe like now we can, concerned of the time, we can get forward and start closing the session for today. So once again, I would like to thank a lot our speakers who have been giving us a lot of great insights. And I think most likely it was a very useful session for all of us. I will get indeed next to the next slide and try to see if you're interested in leveraging the value of AI in your own trading operations or in your applications related to energy markets. Please don't hesitate to pass by our booth. We're going to be present at eWorld, one of the main fairs attaining around the energy and water world. Is going to be from the 21st to the 23rd of June in Essen, Germany. We all wait you there, like don't hesitate to pass by. Or other ways could be to get a 1 month free trial on our short-term forecasting solution. We have several markets in which we are active, so really don't hesitate to share with us your needs and contact us with those regards. Finally, you can book a meeting with us in order to discuss what are your specific needs. Like Pierre was mentioning before in the presentation, we are really able to tailor our solution and our optimization functions in order to really accommodate what is your priority and what is really important for you in terms of indeed trading actions. Hence, really don't hesitate to book a meeting with us in order to actually discuss those items together. We look forward to seeing you very soon. Really appreciate the participation to our webinar, and one last time, thanks a lot to our speakers for the great insights. And wishing to all of you a great afternoon, and see you at the next webinar.